$184 silver. You must be thinking this is clickbait. It is possible that silver could go to this figure literally overnight. What will happen to the price of silver and other precious metals if gold is revalued to $15,000? So the gold market is worth $22.87 trillion. That's the circulating supply. The silver market is worth 1/10 of that. It's a very small market compared with gold. It's worth around it's worth $2 trillion, less than 1/10 of the circulating supply of gold.
With financial tensions building and U.S. debt levels rising unsustainably, speculation is intensifying around drastic measures the government could take to stabilize its fiscal position. One proposal, gaining traction among economists and market watchers, involves a historic revaluation of gold by the U.S. Treasury, a strategy not seen since the 1930s. According to analyst Clive Thompson, this four-step process could rapidly shift the landscape of both the U.S. dollar and the precious metals markets. It begins with the Treasury redeeming the Federal Reserve's gold certificates, worth $11 billion, at face value. The president would then issue an executive order revaluing gold to $15,000 an ounce. In a crucial move, the Treasury could sell this revalued gold to the Federal Reserve in exchange for newly created digital dollars, injecting an estimated $3 trillion into the economy. This liquidity could eliminate the annual deficit and pay down maturing debt, all without increasing the national debt. But the impact wouldn't stop with gold. Thompson explains that such a bold monetary shift would send shockwaves through the entire precious metals sector. The total gold market is valued at nearly $23 trillion, while silver's global market cap sits at less than $2 trillion. If just 3% of gold holders choose to sell their gold at the new price and redirect half of those proceeds into silver, that alone would inject about $1.5 trillion into the silver market. Given that only 10% of silver holders are assumed to sell, the supply-demand imbalance could trigger a price explosion. Based on this model, silver could rise to as much as $184.50 per ounce, a more than four-fold increase from current levels. Clive Thompson underscores that while this is a theoretical scenario, it is grounded in historical precedent and economic logic. A similar revaluation strategy was used under the Gold Reserve Act of 1934, proving that such maneuvers are not without precedent. The broader implication is profound. In a world of fiat devaluation and ballooning debt, precious metals, especially silver, could provide a form of financial refuge and opportunity. Thompson's analysis suggests that silver may be uniquely positioned for asymmetric upside, and investors who understand these dynamics early could be preparing for one of the most consequential repricings in modern financial history. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The very first step is the Treasury can redeem the Federal Reserve's gold certificate at its face value. That's 11 billion, not trillion, billion dollars. So that will cost the Treasury $11 billion. And don't worry, I'm going to get to the silver price shortly, so stay tuned on that one. Step 2, the president can issue an executive order which changes the statutory price of gold to, let's say, $15,000 an ounce. Step 3, and this is the crucial step which is required to generate the cash and to generate a profit for the Treasury in the current year, to turn the current year's deficit into a profit. So in step 3, the Treasury sells the newly valued gold, now worth $15,000, to the Federal Reserve for $15,000 an ounce, and in exchange receives the value of that gold in newly printed electronic cash. And then the last step is exactly the same step, the magic step that they did in 1934. It's just a repetition of something which has already been done in history. And this can be done again by a new Act of Parliament, by a new Act of the government. In 1934, the Act was called the Gold Reserve Act. So in step 4, the Treasury immediately buys back that exact same gold from the Federal Reserve at the same price as the Federal Reserve just paid, so there's no profit or loss for the Federal Reserve, and gives the Federal Reserve in exchange gold certificates, exactly the same type of gold certificates as they hold at the moment. Now remember, these gold certificates are not part of the national debt and they don't bear any interest. They're irredeemable by the holder, they're perpetual, and they pay no interest. So what happens? The Treasury gets its gold back, and basically the Treasury is $3.9 trillion richer, which it can use to turn the current year's deficit into a surplus, and they'll be able to repay a lot of the debt which is maturing over the next 6 to 9 months, reducing the national debt. Now, here's the question which everybody's been waiting for. What will happen to the price of silver and other precious metals if gold is revalued to $15,000? So the gold market is worth $22.87 trillion. That's the circulating supply. The silver market is worth 1/10 of that. It's a very small market compared with gold. It's worth around it's worth $2 trillion, less than 1/10 of the circulating supply of gold. And the platinum market is even smaller. It's almost 1/10 of the size of the silver market at $257 billion. So gold is the big market, silver is 1/10 of that, less than 1/10, and platinum's nearly 1/10 of that. So what would happen to the silver price, and what's the maths? I'm going to look at that for you now. Perhaps just to give you some relative market caps, let's just have a quick look at some other assets which are circulating. So gold has a market cap of 22.87 trillion. Put that in perspective, Nvidia's 4 trillion, Bitcoin's 2 trillion, silver's 2 trillion, platinum is 257 billion, palladium is 214 billion. So the silver market is tiny compared with the gold market, less than 1/10 of the size, and the platinum market's smaller still. So for the sake of this exercise, to work out what the silver price could be literally overnight if gold is revalued. And I'm going to make a few assumptions, and you can make the same assumptions or different assumptions to arrive at your own figure. So let's assume that, first of all, the President revalues gold at $15,000 an ounce, and therefore that means that the Treasury is standing ready to buy gold from all comers at $15,000 an ounce. A really good thing for the Treasury. They get a lot more gold with from effectively newly printed paper. So I think whilst there'll be plenty of people willing to swap their gold for worthless paper, the Treasury will be only too happy to take the valuable gold for paper which it can print like there's no tomorrow via the Federal Reserve. So I'm going to assume that not everybody rushes down to the Treasury to sell their gold at $15,000. For this exercise, I'll assume that 3% of people who hold gold decide to sell it to the Treasury or to someone else at the new price of $15,000 an ounce. Only 3%. And I'm going to assume that when they get that money, half of that money they decide to reinvest in other precious metals, specifically silver in this case. And then you've got to look at how many existing silver sellers will be selling their silver to these people who want to buy it. Well, I'm going to say only 10% of silver holders will be willing to sell. And now let's see how that would affect the silver price. So there's my assumptions on the screen. You can see what I'm assuming. So let's go through this step by step. So you can see on the screen what would happen, and you can see the maths. So assuming that 3% of the gold is sold back to the Treasury at $15,000 an ounce, that would generate for the sellers $2.97 trillion, or let's call it $3 trillion for simplicity, in cash. And we're going to assume that half of that cash will then find its way into the silver market and be invested in silver. And we're assuming that only 10% of people of the people who own silver will sell some. So what we then do is take the amount of silver ounces which will be sold. You can see the maths on the screen. Take a screenshot if you want to. Amount of silver being sold. We'll take the total cash available divided by the number of ounces of silver which would be sold, and we see that we arrive at a price of $184.50 an ounce. Now, of course, there were three assumptions in there. We're assuming that 3% of the gold is redeemed for $15,000 at the Treasury. We're assuming half the money goes into silver, and we're assuming that only 10% of silver holders decide to sell their silver. Change any of these parameters and you'll get to a different number. But I think that's a good guess at $184.50 per ounce.
The United States currently faces a critical financial challenge stemming from its enormous national debt, a significant portion of which is due for repayment or refinancing within the next 4 years. This looming debt burden comes at a time when interest rates are rising, making the cost of borrowing substantially higher than in previous years. Economists and financial experts agree that the current path of accumulating debt without addressing its consequences is unsustainable. Clive Thompson emphasizes that a key asset often overlooked in this crisis is the U.S. government's gold reserves. The Treasury holds 261.5 million ounces of gold, yet it remains valued at the antiquated statutory price of $42.22 per ounce, set in 1972. Reassessing this value to reflect current market realities, potentially around $15,000 per ounce, could inject nearly $4 trillion into government coffers. This influx would provide a crucial financial buffer to cover budget deficits, reduce debt maturities, and help stabilize the nation's fiscal outlook. Such a strategic move would not only reshape the Treasury's balance sheet, but could also have profound ripple effects across global financial markets. Thompson points out that the revaluation would likely occur without prior public announcement, with only subtle signals such as an unexplained rise in gold prices. This could trigger a surge in demand for precious metals like silver, as investors reposition in anticipation of broader economic shifts. Moreover, the Treasury's recent statements about monetizing assets suggest that preparations for this approach may already be underway. While the exact timing and scale of a gold price adjustment remain uncertain, the potential for this asset to serve as a powerful tool in addressing the debt crisis is increasingly recognized by financial experts and policymakers alike.
The real problem that we have with the United States at the moment is the huge value of the debt. There's a massive amount of debt coming due in the next 4 years, which has to be rolled over at much higher interest rates than previously. This can't continue indefinitely. It's not possible to continue taking on debt indefinitely without any consequences. Something has to be done. Let's look at something which is being considered by the United States, and that is the revaluation of gold. And I'm going to talk about that and why we see it. So let's start with the position of Secretary to the Treasury in the United States. It's the most important position in the country when it comes to the managing the finances of the United States. Based on the amount of money being managed, it's a position which is many times more important than Jerome Powell's position as head of the Federal Reserve. Secretary of the Treasury is literally the most important position in the United States when it comes to finance. So Scott Bessent is the current Secretary to the Treasury. He succeeded Janet Yellen. Scott Bessent was sworn in as Secretary to the Treasury on January the 28th, 2025 this year. A few days later, in his new position as Secretary of the Treasury, he said the following words, and I quote, we're going to monetize the asset side of the US balance sheet for the American people. Now, what does that mean? Well, for those who understand what the balance sheet is and what the assets are, there's one asset he must be talking about, at least everybody thinks so, and that is the most liquid and the most undervalued asset on the Treasury's balance sheet. And that asset is 261.5 million ounces of gold, which is valued by the Treasury at the statutory price of $42.22. That's a price which was set by law in 1972. So those 261.5 million ounces at $42.22 are worth $11 billion. So the questions everybody's asking, and I'll come back to all these questions shortly, but I'll read the questions out. 1, when will it happen? 2, what will be the new gold price? 3, how will it happen? 4, will they take my gold, just like they did in 1933? Will they confiscate it? Don't forget, 1934, 1 year after they confiscated people's gold, they raised the price from $20 to $35 an ounce, an increase of 69% in one night. How will it affect the price of silver and other precious metals? Now, that's what you want to hear about, and I'm going to talk about that. I'm going to tell you how I get to my $184 price. Will it cause a collapse of the currency and massive inflation? So I'm going to break these questions down for you one by one. Let's start with the first question. When will it happen? Well, there's not going to be any official warning. Those who are in the know will be sworn to secrecy. However, as is always the case, there will be many people involved in the planning, and the secret is bound to leak out. Someone will tell their partner will tell their dad, the dad will tell his mates at the next barbecue, and so on. And of course, dad's mates are all going to pile into gold. Pretty soon, there'll be a large group of people in the know who were never supposed to know. But you won't know, except you're hearing it here. You won't know when. Your only warning sign will be a rapidly rising gold price without any apparent reason. There'll be no accompanying story. No wars, no surge in inflation, no default. But the question is still when. Well, the button's likely to be pushed when the economy needs a stimulus. Or it could be pushed when some emergency action is needed due to some event, such as a Liz Truss moment. Liz Truss moment in the UK was a bond crisis, a gilts crisis, so it might be a crisis in the US Treasury market. The second question is, what will be the new gold price? Well, we've heard all kinds of figures from the current price of $3,300 all the way up to $150,000. The most popular quoted figure is $20,000 an ounce. I have my reasons to think that's probably going to be a little bit too high. I think the figure will be $15,000 an ounce. It's a guess. I don't have inside information. But $15,000 is about 4.5 times higher than today's price of $3,300. Now, each price has its pros and its cons. But any price, from the present price of $3,300 all the way up to the highest possible figure, is going to create a profit for the Treasury, and it's also going to create a lot of newly printed cash for the Treasury if it's done right, yet allowing the Treasury to keep the gold. And I'm going to describe in a minute how, with a little bit of accounting magic, the Treasury can create trillions of dollars of newly spendable money, which can eliminate the budget deficit for the next 2 years, can reduce government debt, and allow the Treasury to keep its gold. And that absolutely is possible.
As the national debt reaches unsustainable heights, policymakers may turn to unconventional strategies to stabilize the economy, including a significant upward adjustment in gold's official valuation. By increasing gold's price dramatically, the government could tap into a previously undervalued asset, generating substantial new liquidity to help cover budget deficits and repay debt maturing in the near term. This major shift in gold's market value would ripple across the broader precious metals sector, especially impacting silver, whose market size is considerably smaller and therefore more sensitive to capital movements. Investors reallocating even a modest portion of their gold holdings into silver could create intense demand pressures, sharply tightening supply and triggering a rapid surge in silver prices. Share your thoughts on Clive's analysis of gold and silver prices in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.